This is the most important thing I've learned investing in the stock market, and it's this. Welcome to Stock Stories. Hello, my name is Alex Mason. I am your stock storyteller. And today we're going to be going through the top 100 lessons that I've learned investing in the stock market over the course of my 20s. My wife and I worked really hard to learn about money and investing, eventually becoming financially independent by 30 years old. And I want to share with you the biggest lessons that I've learned specific to the stock market. So let's go ahead and get right into it. Number one, why invest in the first place? What's the point? The point is to turn small amounts of money into large amounts of money. That's really it. That's the only reason why we do it. We're literally multiplying money. So investing is important. If you just want to save money, put money in a bank or in your mattress or somewhere, then you'll have it later when you reach for it. But investing money is the actual act of multiplying your funds. And that's why it's so important. And I didn't mention, by the way that these 100 lessons are structured is generally from beginner to intermediate to advanced. I have 3 different sections. So stick along with me to the end if you're an experienced investor and you want to learn some more sophisticated things that I've learned over the years. And if you're a newbie, this is the section for you because they're elementary lessons. So let's keep going. All right, the second thing that you need to learn in investing in the stock market is you need to get really clear on your investing goals. What is it you're trying to achieve? Think about the time frame. Project out into the future and think about your life 1 year from now, 5 years from now, 10 years from now. Now, it's important to recognize that when you invest, in general, you're going to make more money the longer you're invested. So right now you can see maybe you don't have that much money. And then if you invest for a year, maybe you'll have a little bit more. But then after 10 years, that's when it really starts to stack up. And this is what I saw in my own life with investing. It didn't really seem like much was happening in year 1 or even year 2. But definitely by year 5, year 6 or 7, 10 years in, I definitely saw a huge difference within my family's portfolio. So think about your time frame. Number 3. So what is investing really? Investing is putting your money to work. Every dollar bill that you put into an investment account should be working for you. And that's why I have this little dollar bill that I drew going off to work, because you're actually putting money to work. Having investments is really like having someone else working for you, because the income that you earn from your investments can be spent just as easily as the income that you earn from your job or how you actively earn money. So make sure that you put your money to work. There are a couple different types of ways that we can measure our returns when we're investing in the stock market. And the way that I look at this is kind of like absolute performance versus relative performance. Now, you may have heard of mutual funds. Mutual funds are groups of stocks basically that get put together and you invest in the fund that holds those stocks. Now, the manager can change it out over time, but usually in the mutual fund industry, managers are focused on relative performance. So for example, beating the S&P 500, which is a common index, or beating the Russell 2000, which is another index or group of companies. Now contrast that with hedge funds, or more absolute performance. So the other philosophy is, look, we don't really care what the stock market is doing. We don't really care that much about how these other guys are doing. Our job, number 1, is to not lose money and or make a certain benchmark of a return. So hedge funds are more focused on growing money in all environments. So whether you're in a recession, whether it's good times, you want to make money. And neither of these two perspectives are necessarily right or wrong. They're just different ways of thinking about investing. So when you're thinking about your investing goals, think about whether you want absolute performance or relative performance, because that's going to influence how you go forward. Okay, number 5, what are you buying when you're buying shares of stock? What are you actually putting your money into? Well, you're putting money into real businesses. You can see a real business. So if you have a company here and you take a little teeny slice of this pie, these are your shares. That means that you have a legal right to both the profit and losses of the company that you're investing in. And that's pretty amazing, because if you own a company that is wildly successful, guess what? You, as a shareholder, are entitled to those profits. So never forget that. You're not just watching ticker symbols flash across the screen and all these crazy charts going up and down. No, when you purchase shares of a stock, you're buying a piece of a real business. So that's lesson number 5. Now, when we're buying shares of these companies, we have to understand what these businesses are worth, right? We don't just want to throw money at a company because we think it's cool or because we like the product or service. That's not a good enough reason to commit your hard-earned money into buying shares of stock. So what are businesses worth? Well, there's a term in the investor community that we use called intrinsic value. Intrinsic value. And we're going to be talking about this a lot more in future lessons throughout this episode. But intrinsic value is the fundamental worth of a business. Now, if a business is generating $1 million per year, it's pretty obvious that that business is worth more or has a higher intrinsic value than a business that generates $10,000 a year. So there are things that we can look at in terms of the financials of the company, different characteristics that help us understand what this really is. But just remember, you want to buy companies based on their discount to intrinsic value. All right, number 7, greed versus fear. This is what you see the deviations in the market exhibit all the time, day to day. You see prices go up, you see prices go down. This is driven in the short term by emotions. They're driven by greed. We want to make money, and also by fear. We're afraid of losing money. And these are very powerful psychological forces that cause investors, both novice and experienced alike, to make crazy decisions. And you can see it's kind of like a seesaw here. Sometimes the market is cold and fear kind of reigns supreme. Sometimes the market is greedy and greed reigns supreme. So be conscious of this when you're investing. All right, moving on to number 8, margin of safety. And we talked about intrinsic value a few minutes ago. And remember, that's fundamentally what the business is worth. So when we're buying shares as an investor, we want to buy below intrinsic value because we want to get a good deal on our purchase. And that's exactly what a margin of safety is. We want to buy here. Now, you've probably heard the saying, buy low, sell high. And that's basically true. You want to buy when the price is low, not when the price is super high, because you may end up losing out. There are a lot of investors who get really excited about buying these innovative, fast-growing companies, but they pay such a high price for them that their expectations, if they don't work out, they could lose a lot of money with even just a small change in the sentiment of the market. So you want to buy down here, focus on a good margin of safety. Number 9 is be careful with your emotions. Don't fall in love with your stocks. I've made this mistake and falling in love with a stock that really, based on objective analysis, I had no business buying. So let me save you some money, save you some heartache. Don't fall in love with your stocks. Fall in love with your socks. I guess you could fall in love with your socks. Yeah, I love my socks. Don't fall in love with your stocks because it could be very dangerous for you as an investor. Number 10, understand that investments take time. We talked about time horizon a little bit. Maybe you want to hold your stocks for several years, but understand that sometimes things happen quickly, sometimes things happen slowly. It just depends on the specific situation. You may buy a stock and then the next day it goes up 10%. That can happen, especially if you buy before earnings or something like that. But sometimes you'll buy a stock and it may just sit there or even go down for years before it ultimately goes out to make a lot of money for you. So just be patient with your purchases. Number 11, watch out for high interest credit card debt. Now, a lot of people get excited about investing, but they haven't mastered basic personal finance skills first. And this is really important because you don't want to be in a situation where you're investing some money here in the stock market, but then you've got all this high interest credit card debt over here, and then all of a sudden you have to cash out your stocks at an inopportune time just to wipe your debt away. So this is just a note to please make sure your credit cards are paid before you go ahead and invest in the market. Just my opinion. Number 12, time horizon. Different investments have different time horizons. We talked about time a little bit in the sense of different stocks may take a certain amount of time before you see the results, but think more broadly here for a second. Think about terms of general asset classes. For example, bonds may have durations as short as a year or even shorter. Maybe they have durations of 30 years. It just depends on the type of bond that you buy. And remember, bonds are when you lend money as opposed to buy equity, which is buying shares of stock. Stock, on the other hand, you're buying equity. This might take much longer to materialize. So understand that different asset classes have different time horizons. Number 13. Now this thing right here is a thing of beauty, the 10K. The 10K is a document that's filed with all public companies with the SEC, that's the Security and Exchange Commission in the United States. And within this document, you will learn so many things. You will learn what a business does. You will learn about their financials. You will learn about all sorts of things related to competition and how the management is thinking about their position in the marketplace. It's an incredibly insightful document. And so all you need to do to get to this document is go to the investor relations section of the company's website, and you should be able to pull this up. It's either called 10K or annual report. Sometimes companies combine the two documents, but this is super helpful as an investor. Number 14 down here, you'll see 13K. This is another document that's filed with the SEC by publicly traded companies. And this document tells you asset managers, so institutional people who manage money for a living, what their holdings are, what their positions are in different businesses. Now, this thing right here, this is why people know what Warren Buffett buys in the market, is because of these 13Ks. So Berkshire Hathaway, his company, has to file them as a publicly traded company with the SEC. So investors are able to find out. Now, of course, the information is somewhat old by the time it's publicly released, but nonetheless, it reveals information about how investors are making decisions. So this can be pretty useful to us as individual investors because we can learn how institutional money managers are thinking and what they're buying or selling in their own portfolios. Number 15 here, this is the CEO's letter. Now, it's similar to the 10K. They kind of tie together, but you won't find the CEO's letter in the SEC database. This is usually going to be found just on the company's website in the investor relations section, usually at the top of their annual report. And the CEO's letter is super insightful sometimes because CEOs, they're the ones who are running this business. They're driving this engine for you. So if you want to make money with them, you need to understand what their perspectives are and how they're seeing the business positioning in the marketplace. Number 16, financial statements. So in that 10K that we just talked about, you're going to find three main documents or areas of the document that will give you a ton of insightful information as to how the business's finances work. And these are these three documents. You have the income statement, the balance sheets, and then the cash flow statement. Back in the day, companies used to just have these first two, but then it later got expanded to this third one, and they all do different things. The income statement tells you about a business's profitability. The balance sheet tells you about the business's financial strength, and then the cash flow statement tells you about how much cash is coming into and out of the business. So they're all very important, and they're all linked to each other. So it's very important to learn about each of these three documents. Number 17, assets versus liabilities. Now, within one of those documents from number 16, the balance sheet, there are two main pieces of information. You have assets at the top, liabilities at the bottom. Now, what do these things mean? What's their purpose? Well, assets are things that make you money. They're things that generate income for you. So think about a business that operates a machinery plant. All of the machines in the plants, you need them because they're actually producing the product that are making you money. Now, conversely, liabilities, these are things that take money away from you as a business. So these are things like your debt load. If you owe a lot of debt, well, that's a liability. You have to eventually pay that debt off, and in the meantime, pay interest to the bank. So that's the difference between assets and liabilities. Number 18. A lot of people get excited about businesses that are growing really fast. I mean, these are the ones you always hear about in the news, on CNBC, or on your investor apps or your podcast. These are businesses that are generating all the buzz. Why? Because they're growing revenue really fast in almost all cases. These are the types of businesses that Wall Street tends to get excited about. Now, this can be great and is an awesome place to begin your research as an investor, but don't confuse revenue with profits. Just because a business is making a lot of money on the top end doesn't mean it's all flowing down to the bottom end. Revenue does not equal profits. Very important to understand. Again, it's okay to invest in a business that doesn't necessarily have profits yet if you feel like it's going to make a ton of profits in the future, but just understand that there is a difference. Number 19 and number 20. Now, speaking of the difference between revenue and profits, what are some common valuation metrics that we can use to gauge how expensive or how cheap a stock is? Well, if a business isn't quite profitable just yet, but it does have revenue, we can use something called a price to sales ratio. Now, remember, sales equals revenue, so those are interchangeable terms. So you take the price of the stock and you divide it by the sales per share, and that gives you the price to sales ratio. So here in this example, if you have a stock trading at $100 per share, and then it's making $30 per share in sales, then your ratio is 3, 100 divided by 3. Pretty simple, right? Now, it's very similar with the price to earnings ratio. Now, earnings is just another way of saying profits. So if you have a profitable business, you can use this ratio to gauge very quick and dirty way of how expensive or how cheap it is. So if you have a business that is trading at $100 per share and is making $5 per share in profits, well, then you have a PE ratio of 20. So these are just some very simple valuation tools that you can use when you're first looking at a stock. Number 21, let's talk about trading for a second. Now, buy and hold investing or long-term investing is very different than the operation of trading stocks. Now, trading stocks are basically banking on very short price fluctuations in the market that happen for a variety of reasons. Remember we talked about greed and fear earlier? Well, that's what makes these lines go up and down really fast. Now, this chart is just kind of a generic chart, but this could be for a day, it could be for a month, or it could even be for a single hour or minute. You can see there's just many different levels of price fluctuations in the market, and traders try to take advantage of this volatility by either buying low and selling high, or selling high and buying low in the case of shorting a stock. So just a word of caution with trading. Trading can work. I have seen it work firsthand, but just understand that it's very tricky. It's a completely different operation from long-term investing. So if you're focused on trading, then the rest of this video really isn't for you because we're really talking about long-term investing. Go find someone else who can teach you that a little bit better. Number 22, when we think about our mindset and our orientation with long-term investing, there are a couple different ways we can go. We can go on the active end or more on the passive end. Now, passive end is basically sitting back, letting the businesses you own do their thing and reaping the benefits as a shareholder. Active is more about going in and out of the market more quickly, making more decisions, basically. So day trading falls on the end of this spectrum over here. Swing trading, this is similar to day trading, except you might hold the position for maybe weeks or months at a time instead of days or hours. And then over here, buy and hold for a few years. It's somewhere in the middle. So you buy a stock and then 2 years later you sell it for a profit. That's somewhere in the middle here. Buy and hold until retirement. Now you're talking about holding a stock over a period of decades. And then over here, the most passive you can get is to literally just never sell and buy shares of wonderful companies and then pass those shares on to the next generation. So there's a whole spectrum of activity within investing, and you have to decide what fits for you based on your personality and your needs. Number 23, the age of a business can help demonstrate the proof of concept of its business model. Many businesses are starting every day in many different industries, often creating new industries that are very exciting. But the reality is most of these businesses will fail. If you see a business that's been around for many years, that is literal tangible proof that that business model is working. Something about that setup is making economic sense for the owners of that business and for the customers of that business. So think about that when looking for different stocks or different businesses. You don't always need to invest in businesses that are doing something breakthrough and completely original. You can buy a company that just happens to be competing very well against other players in an established industry. Number 24, timeless businesses. Some businesses, they have a time, a moment in society, in culture when they reach the height of their stardom, the height of their prominence. And some businesses fade away over time. Now think about horse and buggy manufacturers in the 1800s. They were the hottest thing around. But then Henry Ford came in and basically created an entirely new industry of automobiles. That's a classic example. But some businesses don't necessarily change like that. Some businesses are truly timeless, no matter what, year after year after year, decade after decade, even centuries later, they're still making virtually the same products with incremental improvements over time. And my favorite example of this is a business that you probably know well. It's Hershey's. Hershey's has been selling chocolate since the 1800s, and they are still selling chocolate. They just sell a lot more now. They sell salty snacks. They sell Reese's peanut butter cups. They sell all kinds of things. But fundamentally, it's timeless. People are always going to want to eat something. And Hershey does their best to sell them the snacks and the treats that people want. So some businesses have their time, their moment in the sun. Other businesses are timeless. Number 25, you have businesses that are old, businesses that are young, businesses that are somewhere in between. But if you can invest in a successfully growing young business, your growth rate potential is much, much, much higher than investing in more established, larger, mature businesses. Because think about it, when you're a baby, think about how fast you grew as a baby. From the time you came into the world to the end of year one, you grew so much. Your percentage of growth rate was incredible. Whereas think about in the last year, if you're an adult, you probably didn't grow at all or very little. And so think about that. In nature, we see this growth rate phenomenon happen. And the same thing is true in the stock market. Smaller businesses have the tendency to grow much faster than large ones. Though not always, they can definitely fail. Number 26, size matters. So small companies tend to grow a lot faster. Mid-sized companies tend to grow somewhere in between fast and slow. And then older companies, bigger companies usually, tend to grow much slower. So keep in mind the life cycle of the company that you're thinking of investing in. Remember, older, bigger tends to grow older and bigger tends to grow slower. Mid-sized companies tend to grow at a medium pace, and then small-sized companies tend to grow very fast. So let me put some numbers to this instead of just being purely conceptual. Small companies, it's not unheard of a small company to grow hundreds and hundreds of % per year, because why not? They're already super small. If they triple their revenue from year to year. That's not entirely unheard of. Mid-sized companies you might see grow in the 20 to 30% range, which is still pretty fast, maybe 15 to 30% range year over year in terms of revenue and profits. And then you have much bigger companies. Take, for example, like a large company like a Caterpillar or a Boeing or a Coca-Cola. Those types of businesses might not grow faster than 5 to 12%, depending on the industry and other factors. But in general, size matters. So if you're looking for certain types of returns, you need to understand this before you invest in certain stocks. Number 27, I want to talk about something that a lot of investors are very confused about. Or maybe they're not confused about, but they just are a little bit misguided, shall we say. People sometimes are obsessed with buying IPOs. Now, what is an IPO? IPO stands for Initial Public Offering. This is when a company first comes out into the scene on the public market, and you, as a member of the public, can buy its shares for the first time. Now, these are usually companies in exciting, new, innovative industries. At least those are the ones that get profiled in the media. And people want to buy these companies because, like, oh my gosh, like Airbnb went public, DoorDash went public, Lyft went public. Let's all rush out and buy the shares. Well, hold up, not so fast. Because if we look at actual data, we can see that usually this doesn't work out. There was a study done of 9,000 stocks between 1968 and 2003. And of these 9,000 stocks, only 4 out of 5 lagged the small cap index, and they tended to underperform the market by 2 to 3%. So that means you had an 80% chance of not beating the small cap index, which is appropriate comparing, IPO companies. So when you think about investing in an IPO, I'm not saying don't do it. I'm not saying I would never do it. I'm just saying that as a beginner investor, you probably shouldn't do it. There's just too much risk there because many of these small companies, they don't make it to become bigger, more established players. So when it comes to IPO, just say no. Number 28, different companies have different types of competitive advantages. And one of the competitive advantages that some companies have is their branding. Brand strength can be tremendous, especially for consumer-facing products. Now, just by drawing some of these logos here, you already know the businesses that I'm about to talk about, right? These are the golden arches for McDonald's, and then this is the Starbucks logo. And they sell coffee, right? They sell coffee, McDonald's sells burgers and fries. And the brand strength of these businesses gives you a feeling that you're going to get a certain experience. So even if you never walked into a certain building before, if you see these golden arches slapped up on top outside of the building, you know, oh, okay, I'm going to have a certain type of experience when I go in here. I'm going to be able to buy a burger for this much, a thing of fries for this much, and you're going to willingly spend your money because branding matters. Branding creates loyalty. So that's one important type of competitive advantage that some businesses offer over others. Number 29, I want to talk to you about different industries for a moment because different industries have different characteristics, and we're going to get into several of them today. One of them is the oil industry. The oil and gas industry tends to have significant price volatility compared to other markets. I mean, look at what the price of oil did in October of 2020 versus March of 2022. They're completely different. And oil and natural gas companies experience a lot of volatility as a result of the underlying commodity that they deal with. Now, another industry that you want to look at is the biotech industry. Biotechnology companies also tend to be very volatile because when you think about the business that they're in, it's kind of like very, very wide range of outcomes could happen. You could invest all this time, research and development into some kind of biotech product that ends up not working out and the company becomes virtually worthless overnight. Or you could have a very critical regulatory approval that goes through, and then all of a sudden you have a monopoly on your niche of the market and you're just making tons of money. And that can cause the stock price to go up very fast. So with these types of industries, as a new investor especially, you want to be very cautious because you will see a lot of volatility with these types of industries. Number 30, boring businesses. A lot of people want to invest in the next Tesla or the next Amazon, including myself, and I think that's okay. But it's also okay to invest in businesses that are considered boring. Why? Because sometimes a boring business will help you sleep well at night. Number 31, exciting businesses. Sometimes you don't want to invest in a boring business, you want to invest in an exciting business. But watch out. Remember what we talked about earlier with regards to revenue versus profits. Even if a business is making tons of revenue and even if it's making tons of profits, we have to ask ourselves the question as investors, is this sustainable? Some businesses may not end up being profitable. AOL was a huge internet business back in the early 2000s that is just a very small fraction of its former self today. Uber has undergone this really big transformation from being this startup to being this huge multi-billion-dollar corporation that's trying to figure out its economics right now in order to be profitable for investors. So just look at businesses not just from the lens of being exciting, but understand what the risks are and whether or not the business has a shot at sustainable profitability. Number 32, I want to talk to you now about the invisible force that steals your wealth from you. And that force is called inflation. This is basically what we see happening in the market right now. People aren't able to buy things with the same amount of money that they were even just 1 or 2 years ago. And so inflation is an invisible force that takes away from your wealth. Well, the way that you beat this is by investing in inflation-beating assets, and stocks are a great asset class historically for beating inflation. So we want to be mindful of how many cheeseburgers are we going to be able to buy 5 years from now with the money that we're investing. We want to be able to buy more cheeseburgers than we do today, right? Because ultimately the purpose of all money is to be spent at some point by someone. So make sure that you're beating inflation with your investment dollars. Number 33 is something I want to share with you, especially if you're a new investor. At first, your returns do not matter. It doesn't matter if you double your money or you quadruple your money if you're just putting in small amounts of money into the market at first. Contrast that with, let's say you have $100,000 and you put it into the market. If you make 10% on your money in a year, you made $10,000. But if you put in, say, $1 into the market and you 10x your money in a year, well, you still just have $10. You see what I'm saying? Rate of return only matters once you've actually got capital to compound. So if you're just getting going with investing, don't sweat it too much if you're making a lot of mistakes and you're just trying to figure things out. You'll learn over time, but don't focus too much on investment returns at the beginning of your journey. Number 34 is I want to talk about investment fees. Investment fees are super important. Fees erode at your return. Now, in some rare cases, fees may be justified because the person managing your money who's charging you those fees may be more than making up for the fees that you're charging you in the returns that they're getting you. But in many cases, this is not the case. So watch out for your investment fees. For an investment with low fees, you're going to make more money ultimately than the same investment with high fees over the same period of time. So watch out for your fees. Number 35. Now we've talked a lot about different specifics of different types of investments and industries and businesses, but now I want to talk about where do you actually put the money? This is the concept called asset allocation versus asset location. With asset allocation, we're talking about things like, all right, how many biotech stocks versus tech stocks do we want? Or how much gold versus bonds versus stocks do we want? It's figuring out the type of investments that you want to be in. Asset location, on the other hand, is determining where you're actually going to put the money. So what bucket are you going to put the money into? You can put the money into something like a 401k retirement plan or an IRA, which are going to give you tax sheltered benefits. Or you can put the money into a plain vanilla brokerage account, which is basically like a bank account for where you put your stocks. So where you put your money matters. Number 36, I want to talk to you now about taxes and your investments. Now, I want to disclaim that I am not a CPA or a financial planner or any sort of tax advisor, but I do want to tell you that when you sell your investments and you make money with them, you're probably going to pay taxes. So there's something called the capital gains tax. And as the way the tax rules stand in the United States right now, if you hold stocks for longer than a year, then you're going to pay a maximum capital gains tax of 15%. Now, of course, that's subject to change over time, right? But essentially, the basic concept is this. The longer you wait and hold your investments, the lower your taxes generally will be. So keep that in mind in your investments. Number 37. Now I'm going to talk about one of the most accessible and popular investment vehicles out today, one that I have used and continue to use myself for some portion of my family's investing, and that is index funds. Index funds are really easy way to invest. You put money into a single fund or maybe a couple of different index funds that represent the broader market, and then that's it. Then you're done. You don't need to do any stock selection. You don't need to do any of this financial analysis stuff. So if that's you, then that sounds great to you. Check out index funds. So index funds can be a great way to invest, and I am an advocate for them. Number 38. Okay, invest in index funds, but what is an index fund? Well, an index fund is just a group of stocks packaged together that mimic a particular index. And an index is just a list of stocks, a list of companies that meet certain criteria. And there are many different famous indexes. The biggest one is probably the S&P 500, but you also have other indexes like the Dow Jones, Russell 2000, S&P 400, the NASDAQ has lists. They all have their own lists. Every company has different lists within various stock exchanges. So when you purchase an index fund, you're buying little pieces of some of the top companies. So you may be buying a little bit of Apple, a little bit of Tesla, a little bit of Microsoft, and then it goes on and on and on. And in a typical index fund, you're going to be owning small pieces of hundreds or even over 1,000 or thousands of different companies. So that's what an index fund is. Number 39. So the S&P 500 is one of the most famous indexes there is. And what studies have shown is that the S&P 500 tends to actually beat out most mutual funds. So remember we talked about active versus passive earlier? Actively managed mutual funds have someone or a group of people trying to actively beat the market. And what history shows is that the majority of them, actually 80% or so, fail at that. So you may just be better off investing in the index and just calling it a day. Now that being said, number 4, every rule has its exception, right? The top 20% of money managers, they do actually beat the index and they make even more money. And that's essentially what I'm trying to do as someone who picks stocks and analyzes individual businesses. I wouldn't be doing all of this research, all of this stuff, if I didn't think that I could make it within the top 20%. So 80-20, you can run with the crowd and just invest in the index, or you can try to manage money yourself or put it with an active manager and try to beat the index if that's your frame of mind. But it's really up to you. Also, it's not a binary decision. You can do both. Number 41. So this is a great one to me because we're talking about average investor performance. And it's about how much time investors spend with their investments in the market versus timing the market, trying to move in and out at the opportune times. Let's buy here, let's sell there, trying to get extra returns through your actions. Well, there was a study done by a group called Dalbar, and they analyzed average investor performance over a 20-year period, 2001 to 2020, And on the y-axis here, you'll see the annualized returns. And here are the stocks in the S&P 500, and then here are the average investor returns. So on average, the stock market did about 7.5% annually over this time frame. But let's see how the average investor did. Ooh, not so great. The average investor got around 2% annually over this time frame. And that's because as individuals, we're wired to think that we can do better somehow than the market itself. And some people can do better, but the average investor cannot. And we can see that bearing out here in the data. There's a massive difference between the amount of money that investors would have made if they just stuck to holding their stocks for a long period of time versus going in and out of the market at various times over the course of time. So a lesson learned there. Number 42, there's a very important concept that as investors we need to understand, and that's called opportunity cost. Opportunity cost is a mental model that basically says that when we do one thing, we by definition can't do another. You can't do two things at once. There's only one way to spend your time, and there's only one way to spend $1 of your money. So let's say you're evaluating investment opportunities, and here I just kind of have on the scales here Google or Alphabet, and then on the other end we have Chevron. Now let's say you're looking at both of these stocks, and maybe you like both of them, and you want to buy both of them, but then you kind of have to decide like which one is the better opportunity. If you invest money in Google, that's one less dollar that you couldn't invest in Chevron or vice versa. Maybe for you this is an obvious decision, pick Google, but you always have to weigh the opportunity costs in the decision that you're making as an investor. Very important concept. Number 43. This is one of my favorite stock investing lessons because I think it's one of the things that's less obvious, but it's no less important than many of the other lessons that we're talking about here today. And that is that as you go along your investing journey, you go about your life, your portfolio and your investments are going to naturally reflect your personality and your temperament. There are some people who would love Nvidia stock. There are some people who are predisposed to healthcare companies like Abbott. There are some people who love consumer staple companies like PepsiCo. Maybe there isn't a wrong answer here. It's just you're going to be drawn to what you're going to be drawn to. There are entrepreneurs who only invest in super stable, super risk-averse stocks because that's what they want. There are other people who only invest in tech companies, and that's all they're interested in. So understand yourself, understand your own psychology, because before you go and try to analyze these different businesses, understand, hey, what am I really trying to do here, and where do I lean here based on my temperament and my personality? Over time, your portfolio will reflect your personality. Number 44, when we invest, we tend to invest strictly within companies that are inside of our home country. This is what's known as a home country bias. When in reality, if we look at the big picture of the world, there's great companies all over the place. And so it would be foolish to only invest in companies that are just in our little area of the world, no matter how powerful or big your economy may be. Now, it is true that the United States makes up about 50% of the world's economy as I'm recording this. So if you invest in large multinationals in the US, you should be pretty diversified as far as international operations. But just to point out to you, to open your eyes a little bit, there are so many great businesses all over the world. And so there are stock markets that can create vast opportunities for you at any given point in time if you know how to find the opportunities and look for them. And this is something that I'm trying to explore a little bit more as well. Number 45, Sometimes businesses have structural issues that just really mess with its ability to turn a profit and make money for you and I as investors. Now, here's the example of a power company. And let's say that there's an earthquake or a major fire. Well, that could severely disrupt this company's operations. So, when we're thinking about risk and investing in individual securities, think about the industry the company is in and think to yourself, what are some major things that could happen that would really mess this up? And in the case of utility companies, natural disasters are one of those things. So be aware of the risks. Sometimes there are structural issues that play a big role in the profitability or success of a business that you might not think about on the surface. Number 46, not all industries are created equal. And in fact, some industries in the stock market tend to perform far worse than your average company or your average industry. And there has been data that's been collected over hundreds of years of stock markets being open. And we've seen that certain types of industries are just really tough at making money. Not saying they can't make money, some of them are great at making money, but the economics are subpar compared to other industries. And these are the examples. Shipbuilders tend to struggle, airlines tend to struggle, and textile companies, aka clothing manufacturers, they tend to struggle too. And if you think about the reasons why, it's pretty interesting. Now, shipbuilders, think about how much money it takes to design and build a modern ship. I mean, that's an incredible amount of capital. You're probably not going to have a ton of money on the back end. So as your profit. So it's going to be difficult to make money there. Airlines, airlines have tons and tons of costs. They have tons of labor costs, tons of fuel costs. If the price of oil goes up, then jet fuel is going to be very expensive for them. And of course, everyone wants cheap airfare, right? So there's a lot of competition. So airlines typically perform not so great as a stock, with few exceptions. And then you have textile companies. I mean, this is evidenced by Warren Buffett with Berkshire Hathaway. I mean, he bought a textile company and it was performing pretty poorly for him, but he ended up using that as a vehicle for him to stuff all of his other really good investments inside and kind of overpower the underperformance of the textile mills that he bought. So these are the worst performing industries historically in the stock market. Number 47. Now, in contrast to some of the worst performing industries in the stock market, of course, you're probably asking, well, Alex, what are the best performing industries within the stock market? I want to invest in those industries. Well, these are the industries right here. These are industries that tend to have really great unit economics, at least historically, and that have produced above average returns for shareholders over long periods of time. Let's take a look at what these are. We see that right here we have tobacco. I mean, tobacco manufacturers have made a killing for their shareholders over the years. When you think about the economics of making a cigarette, it costs almost nothing, but yet you're selling it at a very high price, not to mention, hint, hint, it's an addictive product. So yeah, that's a recipe for making money right there, moral implications aside. Now over here, we see consumer staples. Cheerios, General Mills, Campbell's Soup, Colgate-Palmolive. These are all incredible companies in the history of American capitalism that have returned massive amounts of money to shareholders over well over a century. Some of them, in the case of Colgate-Palmolive, it's been around since the 1800s and it's been just minting money for its owners. So consumer staples companies have made a lot of money. Think about how many people are brushing their teeth every single day, every single week, every single year for the rest of their life. That's like repeat business forever, basically. And then you have companies, pharmaceutical companies. If you can make a pill that will solve a medical or a health issue for someone, that is a recipe for success right there economically, right? So if you're able to have a patent that's competitive, that is well positioned in the market, you can make a lot of money as a pharmaceutical business. So these are the best performing industries historically within the stock market. Number 48, every industry has its own characteristics. And we talked a little bit about oil and gas before. Now we see that oil and gas businesses, they have very cyclical profits. They're booms and then they're busts. With other types of industries, we just talked about Colgate-Palmolive with toothpaste. Well, that industry is pretty steady. You're not going to go way up in any given year, but you're also not going to go way down in any given year either. So it's important to understand these different industry characteristics. Some industries are more volatile than others. Number 49, industries don't stay stagnant either. They evolve and they change over time. Now, back in the 1800s, horse and buggy manufacturers were the hottest thing in transportation, other than maybe railroad companies. Then you have, in the present day, we have modern motor vehicles. And in the future, maybe we'll have cars that fly, a la Back to the Future. Who knows? But industries change over time. So don't expect that just because you bought a stock in a certain industry, that over time it's not going to change industries completely or maybe even invent a brand new industry all on its own. Who knows? Number 50. Now, we talked about how industries change, but let's talk about how individual businesses change. Back a couple of decades ago, there was a company called Odeo, and you probably never heard of it, but it was one of the earliest podcasting platforms that was out there. Now, this business wasn't really working out at the time, but one of the employees started playing around with creating micro blog posts. And this ended up becoming a business all on its own. I put too much tape on here. So today you would recognize Odeo as Twitter. Odeo created a micro blogging platform and completely transformed its business into what we all know it as today. So businesses don't always stay the same. In fact, very often they change. They can change directions completely. It just depends on who's running the business and what kinds of innovations are happening inside of it. Number 51. Now, we've talked about volatility a little bit as far as it relates to different types of industries, but volatility can also relate to the size of the stock. We talked about size in general, but when it comes to the stock price specifically, stocks that are in companies that are pretty young tend to have much more volatile stocks prices compared to companies that are old. They tend to be more stable. So look at that in terms of volatility based on a company's age. Number 52. Now we're getting into some of the more intermediate concepts. So I'm glad that you stuck with me through this point so we can talk about some of the things that I think are really fun. So there's something in the investment community called quality of earnings. It's not just about how much money a business is earning that makes it a potentially good investment. It's the quality of those profits. So some businesses, over time, their quality of earnings can stay exactly the same, even though it may look like less money. But other businesses, they may make a lot of money, but over time, you notice that their quality of earnings is not really that great. Now, let me give you an example of what I mean. Maybe there's a really fast growing startup that's growing at 50% per year, and they're just crushing it year after year after year. They're making money, but there's a major weakness in that business in that, let's say they only have 2 or 3 customers that make up virtually all of their revenue. Well, if one of those customers decides to pull out and go to a competitor, well, then that business is going to be significantly impaired. Contrast that with another business that maybe doesn't make a ton of money and maybe only grows at 10 or 15% per year, but let's say that they have hundreds of customers, a much more diverse customer base. Well, the quality of the earnings of that business is naturally going to be higher than the quality of earnings of the fast growing startup that has a lot of risk in its customer base. So that's just an example to illustrate this concept. So think about quality of earnings, not just quantity of earnings. Number 53, some businesses have high levels of regulation associated with them. And this can be an interesting aspect of investing in stocks because it's kind of both a pro and a con, depending on how you look at it. For example, some businesses like railroads, for example, they have high levels of regulation on them. Or think of a medical device company. The uh, the product technology that those businesses create needs to be vetted by regulatory agencies before they actually make their way into the hands of the consuming public. And this is for good reason, right? Certain technologies and certain things have very specific risks to people. So that can be kind of a barrier to getting products to market. It can make innovation a little bit slower sometimes. But on the flip side, it can be very helpful to a business because it's actually quite difficult to break into some of these industries. So if you're an established player in a highly regulated industry, that can help you. But it can also hurt you too because it takes a while to get things moving in your business compared to other industries that aren't as highly regulated. Number 54. Now, speaking of industries and companies with high levels of regulation, that can be what we call a barrier to entry. And what this means is that if you have some kind of structural aspect of your business or industry that makes it really difficult for new companies to come up and compete with you, then that's going to work in your favor because you don't really have as much competition. Now, here's an example of this. We have a cell tower here. Think about how many phone network providers there are, major network providers. There really aren't that many. In the United States, you have Verizon, you have AT&T, you have T-Mobile and Sprint, which merged, and then you have some smaller players too. It's fragmented, yes, but not that much. Then compare that to phone manufacturers. Of course, you have the dominant players like Apple with iPhone, you've got Samsung, you've got Motorola, you've got Google now with their Google Pixel line. There's all sorts of phone manufacturers. But the number of phone manufacturers that exist in the marketplace and are competing against each other is far higher than the number of phone network providers. Now, why is this? Well, when you think about a phone, it's a smaller device, it's a lower cost item in some cases, but definitely lower cost when compared with a phone network provider to build out a network of cell towers and all the technology that goes into cellular technology. Like, that's a really big deal. It's going to be a lot harder to compete with a phone network provider than with a phone manufacturer. Now, it may still be hard to compete with a phone manufacturer, but you get my point. Relatively, there's just a difference in terms of barrier to entry. Number 55. We've talked a little bit about assets and liabilities so far today, but one aspect that I want to bring up is debt load. When a company owns debt, it's in a way, it's really just serving as a purpose for financing, to make the business grow, to buy back stocks sometimes, to do all sorts of things with that capital. But one thing that I've noticed in investing in stocks is that a lot of these companies, when they take on debt, it never really goes away. It just gets refinanced over time. So a company will borrow money, they'll pay interest on it over time, and then when it comes due, it's like, oh, we have a big principal payment coming due. All right, let's refinance and get different terms. And then they'll just keep rolling this debt over and over and over again. So just because you see debt on a company's balance sheet, don't ever assume that they're gonna be debt free one day necessarily. Corporations tend to keep debt on their balance sheets on purpose as a perpetual source of financing of their operations. So just something to keep in mind. All right, we're not done. I just need to switch pads for a minute. All right, number 56. We just talked about debt burdens a little bit and how companies have perpetual debt loads. Well, that's not true for all types of businesses. Some types of businesses lend themselves to actually having little to no debt. In particular, tech companies tend to be a little bit more debt averse or have less debt than other types of businesses. And the reason why is because the scalability of technology makes the cost of capital lower. So if you see a software business, you can make a lot of connections between customers with your software very quickly for almost free. So that's why money tends to be really cheap for technology-focused companies. So the type of business that you're thinking about investing in will influence the economic characteristics of that business. And one of the ways that you see that embodied is in the debt load of certain businesses. All right, number 57, let's talk about interest rates for a moment. Now, this is a broad generalization, but this is kind of how it works. When interest rates go up, stocks tend to go down, and vice versa. When interest rates go down, stocks tend to go up. Well, Alex, why does this happen? Interest rates, when they go up, that makes other types of investments a little bit more attractive relative to stocks. So as an investor, you're trying to put your money in the place that's going to get you the highest return, right? Well, if you see a bond from the US government that's yielding, let's say, 10%, and there's no risk to it because, well, the government you know is going to pay you back. It's the government, and they can just tax the population base in order to pay you, versus maybe a stock that might yield you 8%, might yield you 10%, might yield you 15%. So you see there's different elements of risk there. You're going to put your money with the government bond. Now, if a government bond is yielding just 2%, well then, yeah, I'm going to put my money in the stock market because maybe I'll make 10% or more per year. And yeah, there's some risk to it, but I'd rather take that risk and make more money than put my money in the safe thing, quote unquote, and make just 2% on my money. So you see, it's all relative. So there's this interplay between interest rates and stocks that's very important for us as investors to understand. Number 58, let's talk about index funds again. We talked about what index funds are and how they differ from other types of investment vehicles, but what's actually in your index fund? I want to break this down for you. So in the S&P 500, which is by far the most popular index fund, there are some major components that take up a bigger than average weighting in the index. So if you were to buy an S&P 500 index fund, what would you actually own? Well, the top holdings, I listed them right here for you. The top holding, as of the time that I recorded this, is Apple at 6.5% of the weighting of the index, which is incredible. Microsoft has 5.8%. Alphabet or Google has 4%. Amazon has 2.9%, and Tesla has about 1.8%. Now, even now as I'm recording this, I'm laughing to myself because things have changed in the market since I drew this up. So I know that these weightings are not exactly accurate, but it gives you a sense of what the market is made up of. The majority of your money is going to go into components like these. In fact, these 5 components make up over 20% of the S&P 500 in terms of percentage of dollars allocated to it. So think about that. Yes, you're diversified across many businesses in an index, but you are disproportionately weighted more towards the top businesses. Number 59, I want to talk about cash. We've talked about debt, now let's talk about cash. Cash is king. Cash is king in any environment in the market, but especially during hard times, during recessions, during depressions. Cash matters. And there's a prime example of that. There was a business back in the 80s and 90s called Wachovia Bank. Some of you watching or listening to this, you don't remember this because you're too young, but some of you who are older, you may remember this logo right here, Wachovia. They had cash, and them as a bank stored a lot of deposits for people. They had a long history of being a well-known, well-run bank, but they ran into a problem. Over the years, they started getting rid of their cash little by little because of all of their liabilities. And because they had so many liabilities, over time, they had no more liquid cash. And guess what happened in 2007? They got caught with their pants down because they didn't have enough cash to cover all of their obligations. And so they ended up being consumed by another bank. It was a huge deal. They had to get broken up. And Wachovia is no more, a bank with well over 100 years of history. Its reputation just completely gone because of a cash crisis. So cash is how companies avoid bankruptcy. So be careful when you're investing because you never want to pick a stock that is not a financially strong business if you plan on holding it through hard times, because cash is what's going to get you through hard times. Number 60, let's talk about a concept called share dilution. Now, let's say that you and I are partners in a company. You own 50% of the business, and I own 50% of the business. Now, if we decide, hey, you know what, we want to raise some more money, but we don't want to go into debt, how do we do it? We can share some of our ownership with someone else. So let's say we bring in a friend and we decide to sell them equal amounts of our stock. So now you own 33%, I own 33%, and this person owns 33%. Well, your percentage of ownership just went down from 50% to 33%, right? So regardless of whether or not the business is making more money or not, your ownership went down. And this is what happens in the stock market all the time is businesses will sell extra shares over time, and that impacts the amount of earnings per share that you actually get as an owner. So this is a very common scenario here where the earnings per share, it just kind of stagnates. Even if the business is making more money year after year, your cut of that money may or may not be going up. So it's very important to think about share dilution. Number 61, the opposite of share dilution is something called share buybacks. Now, this is when management goes into the open market, buys stock, and therefore the existing shareholders that are left that own that stock, their percentage of ownership gets higher and they didn't have to do anything. So this is what happens. Here's an example. AutoZone is a great example of this, the auto parts retailer, because they tend to buy back stock like crazy every single year. So what happens is the board of directors decides, hey, we're going to buy back some of our stock. They'll take a bunch of cash and then they'll go into the open market and then they'll buy back some of these shares and take them for themselves. So that means that you, as the shareholder, will get extra cash per share of the profits because there are less shareholders in existence. So this can be a very good way to make more money as an investor. It can be a very powerful way to accelerate wealth creation when companies buy back their own stock. All right, number 62. Some companies that you invest in are going to make it, but unfortunately, some of them are not. They're going to fail. They're just going to get X'd out of existence because that's the way that capitalism works. So as you invest, understand that some of your investments might not work out, and some of them might not work out in a big way. They might completely go bankrupt. And just recognize that as you invest, you're taking that risk. Now, number 63 is something a little more interesting and usually way better than, of course, a business going bankrupt, is a business that you own might get bought out. You may actually have a business that gets purchased by a private equity firm, a hedge fund, or maybe it's acquired by another larger publicly traded business. This happens all the time in the stock market. And if you invest in single stocks for any length of time, you're probably going to experience this yourself, where a business that you own gets bought out somehow, particularly if it's successful. So that's one thing that you'll see in the stock market. Number 64, I want to tell you about something called efficient market theory. And don't worry, this is not an economics class. We're not going to bust out any equations right now. But I just want to explain the basic concept to you. The basic concept is that in the stock market, especially as technology has evolved, as we've become much more connected, the amount of information that people have is very similar to the amount of information that many other people have. So because of this relatively level playing field with knowledge and information, the theory goes that the stock market has already priced in rationally all of this information at any given point in time. So stocks that are high are probably high for a very good reason. Stocks that are low are probably low for a very good reason. And what we have here is basically you can see these two people talking. They have some kind of secret investment strategy that they're using to make tons of money in the market. Well, they may be able to do that for a little while, but over time, people will find out about this special strategy, and then more and more people will invest according to that strategy. And then it doesn't become so secret anymore. And then it takes away the advantage that these people once had. So, what I'm saying is that let's say that you have some special insight into a certain new industry or a certain company and you invest in it and it makes tons of money for you and it's amazing. Well, investors are going to find out that that stock was successful because they'll see the results and then they'll probably pile in and invest too. Well, the momentum can only go so far. Efficient market theory will basically dictate that rationally, once more and more people know about that investment, they're going to treat it as a regular investment and its growth prospects will slow. Essentially, the market prices in information in a rational way, is the theory. Number 65, I want to talk about analysts for a moment. Now, analysts are professionals who study the stock market day in and day out, and they're often very smart and intelligent people. But there is a bias towards buying stocks over selling stocks in the analyst world and in the world of professional investments. Now, it just happens to be that that's the way that the incentives are structured. So when you see tons of people yelling, buy, 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 know that not all those stocks really should be a buy. It's just the way that the industry works. And for every few people who are saying buy a stock, there's usually one teeny tiny analyst in the corner saying, no, I think we should sell, 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 sell. So just be aware of these biases in the professional investing world and know that people are not unbiased when they make recommendations for or against certain stocks. Number 66. This is one of my favorite concepts. I learned it from legendary investor Howard Marks. And it's basically a matrix of expectations that you should have as an investor. If you're wrong about your investment thesis and you went with the crowd, well, you're going to lose money. If you're a contrarian in your investment thesis and you think something is going to happen that's the opposite of what most people think is going to happen, well, if you're wrong, you're still going to lose a lot of money. Now, if you go with the crowd and you happen to be right, then you're probably going to make money, but it's probably not going to be that much. But where most of the money is made in the stock market is when investors are both contrarian, going against the crowd, and they're right. That's when you tend to make the most money as an investor. And so it's important to have these expectations in mind based on these different characteristics. Number 68, I want to talk about insider buying. When management is running a corporation, they're paid a salary, right? And they may also be paid in stock. But if the business fails, a lot of people who are running companies will just say, okay, that failed, I'm going to move on to the next thing. They don't have a strong incentive to be with that business for the long term and to really see it succeed beyond just their immediate paycheck. But some people that run businesses, they use their own money to actively buy shares of stock in their own company because they truly believe in its long-term success and they have a hand in actually powering that success. So when you see that, that's an indication of skin in the game, and that can be very attractive for us as investors because we want to sit on the same side of the table as the CEOs and the board of directors who is actually running this business for us. We want to have the same incentives as they do. So that alignment can be really key. Now, number 68 is this very similar concept, People lower in the organization, they can also purchase shares of their business. And this is most commonly seen with what's called an ESOP, which stands for Employee Stock Ownership Program. And this can be great because regular employees of businesses can often buy shares of their own company at a discount to the market price and then make money that way. So when you see incentives aligned in this way, it can be a very good thing for shareholders. All right, number 69, let's talk about dividends. Now, first of all, what is a dividend? A dividend is a piece of the profits that a company makes that they send to you. So let's say a business makes a ton of cash, and then at the end of the year, they say, you know what, we're gonna reinvest most of it, but we're gonna send you some of it, and it's gonna go straight to your bank account. That is what a dividend is. And at mature companies, they tend to send lots of their cash to shareholders because they're already big. They already have lots of profits. They can't reinvest all of that money at attractive rates of return in their own business. So they just send it to shareholders as a way of saying, hey, thank you for owning a piece of this business. Here's some of the profits. It's a beautiful thing. Now, number 70 is dividends at small firms. Small firms tend to have really high needs for reinvesting their cash because they just haven't really made it yet. They still have tons of opportunity for growth. And so they're going to take their cash and they're going to put it right back into the business in order to grow as fast and as well as they can. Number 71 is when thinking about dividends, let's not just think about the amounts, lots of money versus not a lot of money coming out as dividends, but think about the quality of the dividends. This is similar to the concept of quality of earnings that we discussed earlier. The quality of the dividends, this relates to something known as the payout ratio. If a business makes a ton of cash and they send you just a little portion as a dividend, well, that dividend check is probably pretty safe because even if the company's profits fell by half and they still sent you a little bit, they could still send you that same amount. Now, contrast that with if a company makes a ton of money in profits and they're sending you the vast majority of it as a dividend. Well, if profits were to fall in half, guess what? They're going to have to cut your dividend check too. So the quality of your dividends really matters when you're thinking about making income from your stock investments. All right, number 72, you still with me? I want to talk to you about the difference between businesses that are growing versus businesses that are profitable. Sometimes businesses are doing both. They're both growing fast and they're highly profitable. But it can also be worthwhile to look at businesses that aren't necessarily growing that fast, but they're highly profitable. And one example of this is a company called VeriSign. You may have never heard of them, but if you've ever registered a website with a .com or a .net domain name, VeriSign helps make that possible. Now, of course, in the early days of the internet, this company was growing pretty fast, but now the internet is a lot more mature and web domains are not being created quite as fast on a percentage basis as they used to be. So it's a business that's growing pretty slowly, but it's highly profitable because how much money does it take to create a domain name? I mean, their business is entirely based on internet technology. So they're highly, highly profitable, and they make up just a teeny tiny size of the market of this huge world of tech companies, of all these different types of software and all kinds of technologies. So companies that are small can still be great investments if they're highly profitable and they dominate their market. So something to think about. Okay, number 73, I want to talk a little bit about portfolio management now. We've done a lot of work in thinking about individual stocks, but let's think about how these things work in context with each other. And this is a concept called risk shifting. Let's say that you own two stocks. One of them is a super risky stock and you own a lot of it, and then another is a relatively safe stock and you don't own that much of it. Well, you can sell some of that risky stock and put it into your safe stock and be more diversified or better diversified. Because, yeah, you may not make as much money with your safe stock, but it's safer, right? So it may be better at holding your money, and you won't lose as much money. So you can kind of shift things in your portfolio sometimes in order to even out your risk or reduce your risk a little bit. All right, number 74, I want to talk to you about the concept of multi-baggers or 100 baggers in the stock market. Yes, it is possible to make 10x your money in the stock market. It is also possible to make 20x, 50x, or even 100 times your money in the stock market. Just check out books by Thomas Phelps, 100 to 1 in the stock market, or Chris Meyer called 100 Baggers, and you'll see evidence for this. Now, when you have a winner in your portfolio, don't just sell it right away. Let that thing ride. Let it ride, because the very best companies and the very best stocks tend to continue to be the very best year after year after year. There are so many stories of investors who buy at a certain price, let's say $1 per share, and then the price goes up to $10 and they say, oh, this is amazing. I made 10 times my money. I'm going to sell right away. And then they miss out on this beautiful opportunity of compounding to go from 10 to 20 to 50 to 100 and even beyond. So when you have a winner in your portfolio, let that thing ride. Number 75, I want to talk to you about unicorns in the stock market. When you invest in a business and it just does exceedingly well, that's what we refer to in the investing community as a unicorn. Now, by definition, they are rare, but they do exist. And one of these can make up for tons and tons of failures or losses in the rest of your portfolio. So keep an eye out for unicorns. They may come along. You never know, but they do exist. All right, let's talk about number 76, called a value trap. Now, this is a mistake that I've made as an investor, and I don't want you to make the same mistake too. A lot of times as new investors, we see the price of a stock going down like this, and we get excited. We say, oh, maybe there's a deal here, especially if the valuation metrics of that business look good, something like, say, a 6 times price to earnings ratio. But we have to be careful, because something like this can happen, and the stock price could go down even further. And the reason that is a lot of times businesses are priced that way for a reason, and the E in this PE ratio might actually be going down, and the price may be going down with it. So even though the valuation may look cheap, the business itself may not be going in the right direction fundamentally, so we end up losing even more money. So watch out for this. Number 77, I want to talk to you about the difference between business performance and stock performance. It is entirely possible for you and I as investors to buy shares of a wonderful business that's just making tons of cash, but still see the share price of our business go down. And this is due more often than not to something called valuation compression. If we buy a stock that's too expensive, even if the business is performing well, the market may gradually lower the valuation premium of that stock to something that's more reasonable. So the fundamentals of the business and the stock price can converge over time. And that's a phenomenon that we need to be wary of as investors. Number 78 is return on equity. Now, this is a metric that's very important in order to understand a company's profitability. And here's the equation for it. It's your income or your profits divided by your equity. Now, what is equity? Well, we can look over here and see that it's income divided by assets minus liabilities. So you can think of equity as the net worth of a business. So the higher this metric is, the more profitable a business is, and it's usually better for us as shareholders. Number 79. So we talked about the definition of return on equity, but let's look at it in context of what it really means for us as investors. Over the long run, a stock's performance in general will mirror the return on equity of the underlying business. What I mean by that is, if stocks are running a marathon and they're running a race, the one with the highest return on equity is probably going to win in the long run. And the reason for that is because return on equity is that net worth of a business growing sustainably over time. And in order for that to happen, a business has to actually be getting more valuable. It actually has to be making more and more profit over time relative to its assets. So high ROE businesses in the long run are going to be low ROE businesses because they have sustainable competitive advantages that are going to carry them through to the end. All right, let's talk about number 80. The valuation of a stock is heavily tied to its expectations. So let's say that we have a stock that's in the market and it's gone up to about here. Now, if the expectations for this business are really poor at that moment in time, then people are expecting it to kind of give meh results. But if the expectations are really high, we can expect that the stock might go way up to here, and people are expecting to make a lot of money. So understand that the valuation of any stock at any given point in time is tied directly to the expectations of the future prospects of that stock. Not the past, but the future prospects of that stock. Number 81, you can get mediocre performance from a mediocre business. So let's say that you have a business that's just kind of cranking out widgets, not really doing anything special. Let's say its price to earnings ratio is 5, so it looks really cheap. And over time, the company makes profits. It increases its profits by a decent amount over time. Well, the stock performance is probably going to be mediocre too. You're going to have mediocre stock performance most likely because the business overall is performing at a mediocre level. Now, number 82, you can also have the same thing happen with a truly excellent business. So let's say the price to earnings ratio of this excellent business is 200 times earnings, which is very, very high. And let's say that the profit growth is amazing. You just have this nice exponential profit curve. Well, your stock performance might also be mediocre, equal to the mediocre business, because you bought at such a different gap in valuation. So remember, valuation and business results kind of interplay together, and here's some examples of how that happens. Number 83 is you have different aspects of a business that we can visualize with a triangle. And I learned this from investor Donald Yackman, who is a famous investor. And there's kind of these 3 different areas that we want to look at when evaluating a business. One is the quality of the business. Another is the value that we can get based on the price in the market. And then another is the growth prospects of the business. And all these 3 aspects, they kind of interplay together. So you may have a high quality business that's growing really fast, but it's not really at a value price right now. You might also have a business that's growing really fast and it looks really cheap, but the quality of the business isn't that high. And really the trifecta of what we're looking for as investors that are long-term stock investors, we want all 3 of these things happening at once. That's really the gold right there. That's what we want. So keep in mind these 3 qualities and these different aspects when analyzing your investments. Number 84. Now we've talked about the different economic characteristics of industries and businesses, but one type of industry we haven't really talked much about yet are banks. Banks are special types of businesses because they use leverage in order to make money. Now when a bank lends a bunch of money out to people who want to borrow money, they make interest income. And when people, customers, deposit their money with the bank and they earn interest from the bank, they pay out interest. And so you can see that there's a certain rate on deposits that they pay out, and then there's also a lending rate which they collect. And the spread between those 2 things is the profit that the bank makes. So that's how a bank makes money. It uses leverage in order to increase its earnings. Something to keep in mind as an investor. Number 85. This is one of my favorite investing concepts, and I learned it from legendary investor Chuck Ackery of Ackery Capital Management. And he basically describes investing as kind of this 3-legged stool that if you have just 1 or 2 of these legs in place, you're probably going to wobble over. So you want to have a firm foundation. And these are the 3 legs. First of all, when you're evaluating a company, you want to have talented management. Management is so critical. Who is steering the ship? Who are you entrusting with your capital? It's very important to make sure that management is great. The second stool is that the business has to be excellent. Is it fundamentally a great business? Are you making lots of money? Do you have opportunities for growth? Are you profitable? Those kinds of things are very important. And then the third thing, which I think is often overlooked and something that I didn't think about much before I came across this concept, is you need great reinvestment opportunities. If the business doesn't have a long runway ahead of it, then you're not going to grow that much, and you're probably not going to be fertile ground for a truly excellent investment. You need to be able to make profits and then reinvest those profits at high rates of return, and then keep reinvesting at high rates of return, and that's going to get you phenomenal growth over a long period of time. So I love this concept. Number 86. Now, when we're thinking about investing in stocks, there are different components of how we actually make money. And what I like to think of it as is risk-adjusted total return. Let me break that down for a sec. Risk-adjusted means I'm not just going to invest in something because it looks cheap. I'm going to adjust for risk and change my expectations in order to get a high value for every dollar I'm putting in. And total return, this refers to the different components of making money with a stock. Namely, here, capital gains. This is what people talk about when they talk about investing in stocks, right? You buy low, you sell high. That's the amount of money you get based on the share price going up. But there are other ways to make money in a stock. You can make money with dividends. A company pays out a portion of its profits to you as a shareholder. And then also, often forgotten about, are these what I call bonus returns. And we're going to talk about that here in a second. Number 87. One way that businesses return cash to shareholders is actually indirectly through something called a something called a spin-off or a split-off. Now, one thing that you might not know is one of the best businesses in the world, McDonald's, actually spun off Chipotle Corporation. And actually, this was technically called a split-off. You could exchange some of your McDonald's shares in order to get shares of Chipotle. And Chipotle, if you've ever followed it in the stock market before, you know that it's been an incredible stock and an incredible business and has returned a lot of money for shareholders. So this can be another way to unlock value as an investor, is by owning these spin-offs or split-offs. Number 88. Let's talk about the concept of international expansion. A lot of companies will say, once they reach a certain maturity level, oh yes, we're gonna make so much more money in the future because we're gonna go to this country and make money. We're gonna go to that country and make money. But are they actually gonna be able to pull it off? Well, sometimes yes and sometimes no. International expansion can be very complex at times. Now, case in point is the company Target Corporation, the famous retailer. Target is based in the United States, and several years ago, they tried to expand. And they decided, you know what? Target needs to be in more places. Let's make Target a big presence in Canada. So they tried to go up here to Canada. The problem is that Target didn't succeed in Canada. It was a massive failure. So Target quickly retreated and went back to focusing on their US operations. So international expansion is complex. You're dealing with different cultures, different systems of government. It's not just plug and play all the time. So be wary of when companies say, we're gonna grow internationally, because they may or may not be able to actually do it successfully. We've talked a little bit about dividends in the past, and here with number 89, I wanna delve into that concept a little bit more. Now, when a company gives you a share of its profits via a dividend, they're giving you actual money. It's awesome. But you have to pay taxes on that money, just like any other form of income, or most other forms of income. Now, when you invest in a country that has more favorable tax treatment towards dividends, you might end up saving a little bit of money. For example, if you're an American and you buy shares of a company in the United Kingdom, the United Kingdom and the United States, as of the time of this recording, has a special tax treaty to not double tax your dividends. So yes, you're gonna pay the US some taxes on your dividends, but you won't have to pay extra taxes necessarily for the UK. And again, I'm not a CPA or a tax advisor, do your own research, but this is just some knowledge for you to know. Contrast that with investing in a company like Italy. You're gonna pay taxes to Italy and you're gonna pay taxes to the United States. So you may really love a company in Italy that you want to invest in that looks amazing, but keep in mind, if you're buying it for the dividend, consider the tax implications. Number 90 is to consider the rules related to what's known as the wash sale rule. So if you have the intention of buying a company, selling a company, and then buying it again, you need to have your tax rules straight. And in the United States, we have this thing called the wash sale rule. So if you buy a security and then you sell it, you can't buy it back within 30 days without paying taxes. So there are some specifics related to that I'm not going to get into, but just know that if you intend on buying, selling, and buying back the exact same security within a short period of time, you need to be careful about your tax rules. Number 91, I want to talk to you about the concepts of floats. Now, this is a little bit more of an advanced concept, but you can imagine it like this. When you invest in a stock, you've got a certain number of shares outstanding, but some of those shares may not actually trade in the open market. Some of those shares might be held by private investors or institutions, or maybe even the founders of the company who hold those shares very closely. They're not open for sale. So the amount of shares that are available to actually trade in the stock market, that's called the float. And the float may or may not be a large percentage of the total shares of that business. So take, for example, a company like DoorDash. Now, you're sitting here in your boat as an investor. You own a certain number of shares of DoorDash. You're just this small little retail investor. And then what could happen, I'm not saying this will happen, but it could happen, is someone, one of these big institutional investors, decides to sell a bunch of their shares all at once on the open market. And if it's a big amount of shares, this is what could happen. This big investor could topple you over and now you're no longer floating because the stock price could go down significantly very quickly because the market's just been flooded with a bunch of shares that are being sold at low prices. So you can be affected as an investor by these big investors when they make moves in the market because of the float that exists in the market. All right, you still with me? Thanks for rocking with me so far. You made it to number 92. We're almost there. We're almost to 100 investing lessons. Thank you so much for sticking with me to this point. Now, lesson number 92. It's a concept called total addressable market, and you might see this written out as TAM. Now, what this means is what is the biggest size of the business that it possibly could be. Because not every product or service is right for everyone, right? I mean, for example, take a Peloton bike. Some people are crazy about these things. They really want them. Some people could have them if they wanted to, but they're just not interested. They say no thanks. And then there are other people who maybe want the product, but based on its pricing, they can't afford it. So your total addressable market is probably going to be limited to these people, right? Who can afford the product and who actually wants it. So think about the market that you're in. If you want to invest in a business and it has a very small addressable market, understand that your upside with regards to growth is going to be more limited than a business that can have everyone as its customer. Take, for example, Coca-Cola. I mean, everyone drinks beverages, right? Not everyone drinks the same beverages, but everyone drinks some beverage. It's a very basic human need. Compare that to, say, an exercise bike that some people may or may not want. Number 93, I want to talk to you about the concept of volume versus margin in businesses. So volume is just the amount of things, right? You can have a business that has very high volume, sells lots of things constantly, An example of this is Walmart. They have very high volumes, but they have small margins. Now, what are margins? Margins are just the profits that they actually make at the end of the day. So they're making high volume, it kind of filters through this big cost structure, and they're making a certain amount, low margin. Now contrast that with a very different type of business called Louis Vuitton Moet Hennessy. This is a luxury conglomerate based in Europe. And they don't sell nearly as many products as Walmart. They sell very, very few products actually, low volume, but the margins on their products are incredibly high. They're very expensive handbags, purses, watches, you name it, bottles of champagne that go for thousands. So because of that, they're still making lots and lots of money. So think about the volume and margin mix for the businesses that you're considering investing in. Obviously, the best thing in a dream scenario is to have both high volume and high margin, because then you're making tons of money, your business is very profitable, and you have a lot of revenue. So think about that when you're looking at different businesses' characteristics. Number 94, let's talk about acquisition logic. Now, businesses don't stand still. We've already established that. One of the ways that businesses evolve is by buying other businesses outright. Now, one example of this was years ago when Microsoft decided they were going to buy LinkedIn. Just like Pac-Man eats the ghost, right? Like, you want to buy things and you want to eat things if you think they're going to be good for you. So Microsoft bought LinkedIn and they paid billions, billions, and billions of dollars. I remember when this acquisition happened, I was like, this is crazy. Why would you buy LinkedIn for billions of dollars? Like, Microsoft is just playing with its cash at this point. But what I didn't realize was the vision they had for this business. I didn't realize that LinkedIn would become ultimately a huge powerhouse, and they make a ton of money now for Microsoft, and they've certainly made a handsome return on their investment. And I didn't see that at the time. Now, not all acquisitions work out this well. Many acquisitions are actually terrible. So just make sure when you see a business that's acquiring another business, do your due diligence and research in order to try to understand if it's a good idea for you or not as a shareholder. Because remember, if you own shares of the business, that's your money they're using to buy these other businesses. So keep that in mind. Number 95, there's this concept called industry stabilization that I think is really important to understand as an investor. Many industries, once the industry itself begins to mature, stabilize into either duopolies or triopolies. And the reason this is because there needs to be enough competition in a given market in order for people to feel they have choice, but not so much competition that companies aren't able to just compete well against each other. So for example, take the beverage industry, the soda industry in particular. There are three main players. You have the Coca-Cola company, you have PepsiCo, and you have Dr. Pepper, which is now Keurig Dr. Pepper. These three companies combined account for over 90% of the market share of the soda market in North America. That's incredible. So all these different brands that you see at the grocery store, there's a very high probability that they are owned, distributed, and marketed by one of these three companies. So industries tend to stabilize into 2 or 3 big players. Number 96, when we invest in stocks, we want to think about risk. And risk is not just some big all-encompassing concept. There are different layers and levels of risk that we can think about that can make us make more intelligent and rational investing decisions. And the way that I think about it is you kind of have these 3 big levels. First of all, you have market risk. So just by putting money into the stock market, if the entire stock market has a terrible day, your stock might get carried along with it for no other reason than that it's part of the broader market. It got sold off overall. Then you have industry level risk. Sometimes industries are doing really well, sometimes they're doing really poorly. So keep that in mind. And then at another level, you have company specific risk. If there's a major disaster or some big news with a new product that comes out, that's going to be company specific. So there are different types of risk to think about when investing in any business. Number 97. Just like with risk, there are many different ways we can look at the prospect of diversification. Now, it's well known that as investors we should be diversified, but what does diversification really mean? We have to dig into it in order to really understand that and to make investing decisions more rationally. And the reality is diversification has many different faces. You could be diversified according to size, according to the demographics of your customers. You could be diversified with regards to your assets or the countries that you operate in. And you can also be diversified with regards to, say, your liabilities or the timing of your cash flows. These are all very different things that paint an entire picture of a business and how it operates. So think about the different phases of diversification. Don't just think about diversification in terms of, well, I own 20 stocks, so I am quote unquote diversified. No, think a little bit more deeply than that. There are many ways to look at diversification. Number 98. Now, we talked about debt a lot earlier today, but I want to talk to you now about a more advanced concept, which is looking at the structure of the debt. So within a company's financial statements, you might find charts that look like this. And it basically shows you the payoff schedule of when the debt matures that the company has on its balance sheet. So maybe this year a company owes a certain amount of money, next year they don't owe that many bonds coming due, and then maybe several years out they have a ton of money outstanding. This is pretty a typical kind of chart that you might see. Now what you wouldn't want to see is if this bar chart this high was way over here to the left and you saw, oh man, this company has a ton of debt due this year, I wonder where they're going to get that money from. Either they're going to have to refinance or they're going to have to issue shares in the market or do something in order to raise capital. So look at how the debt is structured in a business in order to understand its risks with regards to solvency and bankruptcy. Number 99. It's important to think about businesses not in isolation, but let's remember that every business is part of a much broader, much bigger ecosystem. So think about different other players in the market relative to the business that you're investigating. So let's say you have a company here, and just remember, of course, that there are other companies competing against this company. So who are the competitors? Maybe you have a competitor over here or a competitor over there. And then who is this company serving? Who's actually buying the product or service? That's very important. That's something that the CEO should be thinking about. That's something that you as an investor should be thinking about. Who is the customer? And then let's think vertically too. Who is supplying this business? This business doesn't just create something from nothing. They need raw materials from somewhere, whether they're physical raw materials or whether they're raw materials in terms of knowledge, intangible resources, intellectual property. They're getting it from somewhere. Who is supplying this business? So as an investor, it's important to think big picture. Think laterally. Who is the company competing with? Think vertically. Who is supplying the company and who is the customer that is being served by the company? Very important. And the 100th stock investing lesson. This is the most important thing I've learned investing in the stock market, and it's this. Evolution. Evolution is everything. If you're not evolving, you're dying. I learned this principle from Ray Dalio's book, Principles. If you don't know who Ray Dalio is, he founded the world's largest hedge fund, Bridgewater Associates. And in his book, he talks about evolution. We go through this cycle. Businesses go through this cycle. Markets go through this cycle. You go up, you go down, and then you figure out how to evolve and you loop back around, and then you continue the cycle over and over again toward perpetual growth and learning. As investors, it's not just the companies that we invest in that need to evolve, it's us. We need to evolve. We need to get better. We need to learn lessons and implement them in order to figure out how to become better investors. And that's why I'm doing this here. That's why I'm sharing these 100 stock market lessons with you today. Thank you so much for making it this far. You did it. You sat through all of these lessons and learned along here with me. So thank you. I hope you learned something from this, and I hope that you evolved as a result of what I've shared with you here today. Thank you so much. My name is Alex Mason. I am your stock storyteller, and I'll see you next time. We did it! Woo! I always wanted to do that.